Okay, I think I'll start. Good evening, good morning, good afternoon to our all the audience from various parts of the world. Nishwin welcomes you all once again on our webinar series. At the outset, I would like to thank you all for your love and support. Our LinkedIn page followers have crossed 1730 plus, and we are also proud to become an international partner of World Business Angel Investment Forum. And I have been invited to become a member of Global Ethical Governance Standards of Excellence and Quality Leadership Committee, which I'm very happy, excited about it. As regards the topic today, asset owners and investment managers around the world are considering sustainability in investment decision making. Their focus has been shifting to long-term sustainable performance derived by adopting three pillars of ESG. Now, the question comes to everybody's mind, what is ESG investing? ESG, by the way, the three pillars are environmental, social governance, and governance. Investing refers to a class of investing that is also known as sustainable investing. So a term which is used, alternatively with impact investing or SRI investing or value-based investing. And whenever I talk to people, people say, okay, are you talking about sustainability or are you talking about impact-based investing? So these terms are used interchangeably. Today, we'll clarify about all these terms, where they are used and how they are used in investment decision making. It's used by investors to evaluate corporations or the companies, even the startups, and determine the future financial performance of the companies. But ESG factors are subset of non-financial performance indicators, which includes sustainable ethical corporate governance issues such as managing a company's carbon footprint, carbon emissions, ensuring that there are systems in place to ensure accountability. Now, there are factors in investment considerations used also in risk assessment strategies, which are incorporated into both investment decisions as well as risk management processes. So by adopting ESG practices, investment managers are leading the agenda, the topic of the webinar today, doing well by doing good. ESG integration still remains in its infancy, with investors and analysts calling for guidance on exactly how they can do ESG or how they can integrate ESG in their analysis. Today, we have organized this webinar to discuss how to adopt ESG practices and integrate data into analysis before making the investments. Our expert panelists, speakers from investment and asset management industry will share their insights on ESG integration techniques and tell their stories of ESG adoption at their respective firms. So meet Mr. Hardik Shah. Mr. Shah, I ask you to unmute.
Hi.
So Mr. Shah leads ESG practice at GMO and is responsible for building GMO's ESG capability across investment products and asset classes. He's also a member of CFA Institute's ESG working group for financial year 20, whose purpose is to develop a proposal for ESG industry standard for ESG-centric funds and investment strategies. Prior to joining GMO, he has also worked in companies like Sustainalytics and MSCI, where he was involved in reputed projects. Mr. Shah was also voted as #1 research firm analyst who understands the challenges and opportunities facing companies in the Global Independent Research in Responsible Investment Survey. So we are very happy and proud that you came to our panel. Welcome. Most welcome.
Thank you. Hello, everyone.
Meet our next speaker, Ms. Edris Boy. She leads also the ESG practice at Maitri Asset Management, are her main role to develop and maintain the proprietary ESG integrated framework, investment framework. She works with multi-asset class portfolio managers across their investment segments, as well as advise on ESG compliance on a portfolio and deal by deal basis. Before joining Maitri, Edris has managed the sustainability strategy, reporting, and compliance aspects with Hong Leong Asia, an industrial conglomerate on the Singapore Exchange with operations in Singapore, China, and Malaysia. She also worked with KPMG for many years. And when I was talking to her before the webinar, the experience that she has over working with Hong Leong is amazing. And we are looking forward to listen to that today. Now I'd like to request Edris to tell us more about her role at Metri.
Hi, happy to be here. Thank you very much. Good morning, afternoon, and evening to everyone. So my name is Edris. I am the ESG practice lead at Maitri Asset Management. The main thing about my role when I first started joining was to understand why Maitri wanted to go into responsible investing. And what I learned was I joined, actually I'm one of the newer people to join the company. I joined in about April, May last year. And what I learned was they are actually a single family office evolved into a full-fledged asset manager based in Singapore. So they bring with them 70 years of business experience, right? And when I spoke with the family, which is now the fifth generation was just born about 3 months ago. So the fourth generation has started to be in the business. And when I speak to the family members, they all say that family succession planning is very important to them. And the word sustainability comes up a lot, not just within the business, but it starts with the family. They want to sustain this family business for many generations more to come. So when I engage them further, I understand that from a social aspect, they really wanted to ensure that the investments that they have, that they make, are give back or does not go against the current family values. So that was the first step when I worked with them. And going on forward, we really believe in making profits and doing good at the same time. They don't have to compromise with each other. So the next step was then to kind of develop a framework that would enable us to do that. And there was a lot of engagement, a lot of dialogue with the stakeholders in the family, in the senior management, and also with the portfolio managers on what is the appetite, what would the changes they were willing to make with responsible investing, because a lot of them come from a very traditional finance background. And with my introduction in a team last year, there were new conversations that were brought to the table, right? And with that, there was new knowledge, there was an exchange, and we came up with a framework, an investment framework that actually suited the level of investments, the understanding of ESG for the different portfolio managers, all the way to the board members, and who comprise of the family as well. So right now, my main role is to maintain and ensure that on a daily basis, the framework, the investment framework, is actually adhered to. And what that entails is every time before we make an investment, we ensure that the company actually passes a two-tier framework, a decision-making framework, right? The first tier is that there are 6 negative sectors that Maitri does not invest in across the board. We do not invest in companies that engage in adult entertainment, alcohol, tobacco, manufacturing, weapons, recreational cannabis, and gambling. This is more on the social aspect. And when we talk about our flagship sustainable fund, what we additionally had was we excluded coal as well, because we feel that the environmental angle has to come out in our in this sustainable fund. So on a daily basis, that's what I do. And we also, after companies that actually enter our investable universe, Our portfolio managers may decide to invest in them, and depending on the risk, the ESG risk that they carry, they will size them appropriately. They will look at the time horizon of the holdings. And we will, for the ESG team, we will track their performance, especially for controversies. Because I like to bring up the point on the G aspect, the governance. For us, we believe strongly that a company with good governance, from senior management to the board level, is very important, right? Because when they have strong governance, it means that they will carry out what they promise to do. And if they set targets for their E, environmental, and S, social targets, right? Strong governance is an indicator that they will strive to achieve those targets. And that's what we monitor and we track. And that's in general, and I think more questions will follow. So I'll leave the time to Nisha and Hadik.
Yeah, so more questions will follow for you, Idris. Yeah, thank you so much for your introduction. Now I request Mr. Shah to tell us more about his role at GMO. And I was looking for, the full form of GMO. Could you please also tell us, this year?
That's good. Now we've been around for over 40 years. GMO was co-founded by three persons, and then that's the acronym. So Jeremy Grantham, that's the G, and I think he's still very active as a investor, but also as a very passionate proponent of investor action on climate change. So Jeremy is one of our co-founders, and the full form is Grantham, Mayo, Van Otterloo and Company. Our sole business is investment management, so we manage money for predominantly institutional clients who are based across the world. Our headquarters are in Boston, and as I mentioned, we were founded in 1977, so we've been around in doing this for about more than 40 years. GMO, when I say the type of money we manage is for mostly institutional investors. As examples would be public and private pension funds, sovereign wealth funds, and so on. So even in Singapore, the likes of MAS and some of the other larger asset managers, our asset owners rather, are some of our clients. We operate, I would say, pretty much in the full spectrum of public investing. So we have pure equity funds, we have debt funds, we have multi-asset portfolios. We are very, I would say, popularly known in the investment world for our multi-asset solutions. And one of the things that one of our research pieces that is very well read is the GMO 7-year forecast, where we forecast expected returns for various asset classes over a 7-year period. So that's one of the most widely read publications in the industry. A little bit about my role at GMO. So in very simple terms, my job is to help portfolio managers, be it equity or fixed income or multi-asset, to understand ESG information. So what does ESG data mean? Where does it come from? How do you interpret it? And in some ways integrate that into their investment process. So GMO, I would say, predominantly is taking the ESG integration approach. And then I'll talk a little bit about different ways you could integrate ESG later on. But that's in very simple terms what I do and me and my team do. And this spans across geographies. So one day you could be talking about a Chinese small cap company and their ESG or sustainability management practices. The other day you're talking about Facebook and Google. So that's pretty, I would say, good experience. And what I'm trying to do here at GMO is essentially leverage my knowledge gained at both MSCI and Sustainalytics, which are the two large ESG rating houses globally, and kind of, I would say, pick the best of the both worlds and remove noise and see how we can kind of get the most decision useful ESG data for our portfolio managers.
Wow. Thank you so much. Mr. Shah, my questions will go to you. The first one, ESG practitioners, as I just mentioned before starting the webinar, that ESG practitioners use multiple acronyms, terms, and practices whenever they talk about ESG integration. So this makes it very difficult for non-ESG practitioners to know if they are performing ESG analysis or not. So terms such as sustainable investing, ESG investing, socially responsible investing, green investing, ethical investing, and so on. So what is, when we look at all those terms, how do we differentiate ESG investing? Just to give an example, today when I was doing training, there, we were talking about certain characteristics of the company, and it was about my one of the participant asked, can we not write sustainability? I said, if I put sustainability, is a long term goal of a company, then people might just confuse that sustainability is only about environmental issues, right? So yeah, so we need a little bit more clarification around this area, and properly like ESG, because I know that there are frameworks for integrating ESG into investment analysis. So please, there are people who are maybe from non-finance background, but they're very interested in learning about this. So please elaborate, what is ESG investing analysis and integration? So these terms are very technical for those people. So let's, yeah.
Sure. I think it's very important to set the context right up front. So when you say ESG, it means very different things to different people. So I typically use this couple of slides. I hope you can see my screen by now, but I
Yeah.
typically use this as like the ESG 101, if you may call it. I think first and foremost, it's very important to understand what kind of different definitions are existing in the market, right? So for example, the UNPRI, which is the Principles for Responsible Investing, that's kind of I would say the main body which it kind of is promoting responsible investing in the world. Their definition clearly says responsible investing or ESG investing, which is what you're seeing mainstream asset managers like us do, means incorporating ESG factors to better manage risks and generate sustainable long-term returns. So in very simple words, for those who are familiar with finance, your goal is to improve your risk-adjusted returns. Now, this is often confused with the other, let's say the when on the left, which is SRI or the socially responsible investing, where the primary goal is to create a positive impact on the society or the environment. And returns are obviously expected, but it's not the primary goal. So you're not going to maximize returns. You're kind of going to focus on what is the best way you could have a positive environmental or social impact. So this is I would say the key difference between SRI, which probably started 30 years back, with things like exclude tobacco, exclude sin sectors like alcohol, gambling, and so on and so forth. And then over the last decade plus has evolved into, I would say, more focus on identifying material, environmental, social, or governance risks and factoring them into your investment analysis, into your discounted cash flows. So you don't need to be an environmentalist or you don't need to be passionate about sustainability to do responsible investing. It makes, I would say, business sense to do it because these risks are playing out in a much larger fashion than ever before. So you cannot ignore them as a prudent investor. The other point I wanted to just make briefly was there are different ways of incorporating ESG factors into your investment analysis, and this slide basically comes from I would say the most commonly accepted definitions in the industry. There is no gold standard per se. There's no IFRS for ESG yet, right? So I would say that's what's causes the confusion in many ways, but I think this is probably a simpler way to understand it. So on the right hand side, you see the three screening approaches, which essentially either you screen positively, which means just select best in class companies in each sectors and let's say the highest rated ESG companies, or maybe companies with the lowest carbon intensity, whatever you're kind of solving for. Or you do negative screening, which means exclude certain types of sectors that like I already mentioned, or maybe norms-based screening, which is, I would say, largely to minimize reputational risks. So you don't want to be associated with a company that has a major, say, human rights violation and so on and so forth. On the left-hand side, that's where I think most of the action is happening in the last 5 years, and I think for the foreseeable future. Active ownership means engaging with companies, encouraging them to both disclose sustainability parameters, but also improve them over a period of time. Thematic investing is more for, I would say, a little bit advanced investor class, wherein you decide which one or two key ESG topics you want to focus on, and then just deploy capital on those. So for example, fighting climate change, for example, affordable housing, and so on and so forth. And last but certainly not the least, the ESG integration bucket here is where I would say bulk of the mainstream asset management community is tilting towards, and I already defined what this means. So when you hear the BlackRocks of the world, the other large asset managers, everyone is kind of I would say getting us towards a direction where maybe I'm kind of sticking my head out here, but I would say in the next 5 years, integrating ESG would no longer be like a specialized field. It would just be business as usual. So I'll probably pause here and then discuss details later on. Yeah.
Yeah, thank you so much. Okay, my next question goes to Edris. Do you think, like, Edris, Metri is a family office investment management company. So, do you think family offices in Asia are leading the way? It comes to investing in ESG sustainability projects. So, are there other family offices who are also considering ESG in their investments?
Well, in my experience,
Mhm.
in the investors and the families that we speak with, especially in Asia, I think it is not yet at the forefront. Uh, the reason that one of the reasons that we observe is that the businesses are mainly still in their first or generation. These people, right, are Asians. We don't stop working even when we're 80. We just keep going. And so a lot of the business still relies on the first or second generation people. But what we do notice is the millennial generation, uh, probably in their 30s or and younger, they are really bringing these kind of topics into the dinner table, right? And they're slowly shifting it from the dinner table to the working table in the office. And I think these are very difficult conversations because the businesses have been doing, uh, have been operating in a certain way. And what is helping is when the millennial generation, they bring up the point of, um, mom, dad, aunties, uncles, you say that you want the family to be sustainable. You say you want succession planning. What this really means is that we have to look internally at how we are conducting ourselves and what is to come in future, right? Because we can't just say we want succession planning and not work towards that. So this is the kind of conversation that's really happening a lot more. Um, at the moment, it's not a priority for a lot of families, but more and more. And Maitri is in a position to actually make recommendations to them, kind of talk about what we have actually done and what we think could be some of the options that they take. So yeah.
Family offices, right? So I understand that family offices are even like they are themselves family managed, right? So the governance of those family managed businesses or the family itself, and then imagine that, having good governance in their businesses and then thinking about governance in their investments. So it's really doing well by doing good, right? That's
Yes,
the
that's
con.
right. Yeah. And I think a lot of this is a top-down directive. And if
Uh-huh.
that's the tone, which is very much the case for Mindtree, the senior management is very much motivated to go in that direction. And the portfolio managers that are brought in will also move in that direction. One of the reasons I say so is because even though Mindtree is family owned, we're professionally run.
Mhm.
So there's a lot of dialogue and there's a lot of interaction between the family and the professionals.
Mhm.
So this dialogue actually helps both parties to have a much better sense of where we are coming from and how to evolve. Yeah, because it's definitely an evolving journey.
Yes, thank you. Okay, so Mr. Shah, uh, macro and micro ESG issues can actually impact the sustainability and the earnings potential of corporations. So both, like, what factors do you consider in your ESG analysis? Like, and if you can elaborate a little bit on the weightage of the factors, like how much of the macro do you consider and how much of the micro you consider in your analysis?
Sure. So I mean, one thing is very important to understand is in ESG integration, there is typically no one size fits all approach, right? So each portfolio is different. Each portfolio's investment process is very different. And I'll give you a couple of examples of our existing funds. But I think it's very important to understand that you can't just copy paste, let's say, one approach elsewhere. Because, for example, if there is a fund which has top down or macro as a part of its as a part of its investment process, then it makes sense to consider macro ESG risk. But if it's just a pure bottom up stock picking process, then you don't need to kind of force macro in just to kind of show that. So I have a few slides just to, I mean, again, support or help people better understand. Macro point is very important here, and this is where, I mean, where we as GMO are, I would say generally our view is very different from what the market view is. Typically, people in the industry who would look at ESG or integrate ESG would look at company-specific ESG ratings or ESG analysis. Most people don't look at macro level risk, but we very strongly feel it is really important. Case in point, you could be the most sustainable company in, let's say, China or India. What happens at a country level, so be it physical impacts of climate change, be it the recent pandemic and the related shutdowns and so on and so forth. I mean, even the most sustainable airline has still suffered, and the most sustainable hotel chain is still suffering because of COVID, right? So what happens at country level is really important, and that's why we feel we should integrate it wherever it makes sense. We have actually built almost 3 years back now this country ESG Assessment Framework. So we've actually curated more than 50 ESG issues across, I would say, a variety of public sources. So the most typical ones being the World Bank, IMF databases, but also very specialist think tanks which focus on one or two of these ESG issues. And I mean, what you see on the screen is just a sample, let's say, comparison of emerging market countries and how they perform on these factors. What is probably more important to folks on the webinar is what type of issues do you look at, right? So here are some of the examples. So when you're talking about air pollution, which is one of the key issues, we look at factors like number of deaths linked to air pollution. What are the regulations the country is kind of putting in place to minimize or at least keep it in check? The typical biodiversity or climate or carbon emissions kind of stuff. It gets more interesting in SNG essentially, and I think even with the recent pandemic, I think what it has clearly shown is paying attention on the health and wellness kind of preparedness in some ways of countries is very important. So for countries which didn't have sufficient investments made in their healthcare sector, I think they're suffering more with longer lockdowns or maybe larger spread and things like that. So like looking at hospital beds and physicians per, let's say, per 1,000 people and so on and so forth. And the G ones are more common. I think any macro investor would look at these things like degree of let's say judicial independence and so on and so forth. So these are factors which are really important, and these are very separate from what you look at for a company, let's say Tencent, Alibaba, or maybe Reliance Industries, for example. So this is like, I would say, some hint on what kind of factors we look at. How does it go into our investment process? And I have an example from our emerging fundamental equity team. So this team had basically a long-term country valuation framework, which consists of these 4 pillars. I won't go too much in details or bore you, but what we essentially did was we mapped the ESG indicators from the previous framework that I showed in each of these 4 pillars. So now your country attractiveness view is a combination of pure macro factors and ESG factors. And what this essentially did was, if you see on the top, before integrating ESG, this is how we kind of found these countries more attractive. And this is like a domestic demand focused fund. So essentially the countries with larger population and growing middle class would be more attractive. So hence you see China and India being like the most attractive on the further right. After integrating ESG factors, it didn't kind of overturn the whole scale, and that's not what it's supposed to do, because ESG is one of the many things you look at while making decisions. But it essentially did, I would say, moderate our optimism about China and India, because there were a lot of ESG risks that we had not hitherto factored in. So how does this play out for the portfolio managers? The portfolio manager might have had a larger overweight on these countries in absence of ESG integration, but now would probably have neutral or maybe slight overweight versus benchmark. So that's how I think this typically plays out. In terms of company specific ESG issues, I think there what is important is there's no like single long list of issues which applies to all companies, right? It's sector focused. So if you're a bank, then maybe product governance, maybe corporate governance for the bank and things like that would be more important, and less so carbon emissions from their own operations, because you're pretty much using office space and that's about it, or maybe employee travel. But for a utility company, carbon emissions might be the most important issue. So we look at what I would say is a wide variety of materiality frameworks from SASB, GRI, or from our third-party data providers. And what we have done is kind of trying to curate what makes the most sense for different sectors, and then apply that into our thinking. So we don't just kind of rely on third-party ratings. We use them as a starting point, but kind of have our own views on which factors are most important for, let's say, companies in this sector versus that, and then kind of embed that into our evaluation.
Yeah, very interesting slide. I really liked your slide on the countries, ESG factors. So it will be very interesting to see how these could be incorporated even for the startups when we are considering investments in startups, and how to consider the ESG factors while investing. So very interesting. Thank you so much. My next question to address. So all these macro and micro factors, I'm sure Metri is also using those factors, similar factors. What data sources do you use for this analysis, and how do you evaluate the reliability of data? Because as we know that there are a lot of data available and different sources, so there are different companies which are providing ratings, rankings, and so on. So how do we rely on that data, and how do we use that data in our analysis?
Yeah, that is a very important question. A lot of data providers out there at this point in time. I think we look at what kind of layers we actually have. So for Mindtree, our responsible investment approach is 2 tiers. We have a negative sector, the 6 sectors that we do not invest in, and we have another tier for our sustainable fund. So in total, what we're looking for is data that tells us about companies and their exposure in some of these negative sectors. What is their ESG risk score, the company as well as the industry, and also the controversies that are affecting the companies and the industry. We want timely data. So when we look at data partners, we want to see who is the credible ones, who are the reliable ones who've been around for a while, who are the ones who are commonly used. So for us, we use Sustainalytics as well. We use Bloomberg, we use ISS for a different variety of data. Some of the things that we do is we cross-check the data across the different data providers that we use, and also publicly available information that some of the other data providers publish. We also bring that to our portfolio managers to check that what maybe, for instance, a controversy that happened to a company. We go to the portfolio manager and we say, is this something that you've observed as well? This is what we think is going to happen. And do you concur? What's your opinion on that? And we think that the portfolio managers need to have a very significant input when it comes to the ESG analysis. So the decision that we make on an investment is you always 2 tiers. The ESG team sits within the investment team as well. So the dialogue is and the decision is a joint decision at the end of the day. Yeah.
Yeah, thank you. So that is enlightening. So Mr. Shah, when you are evaluating the emerging markets, right, as you just showed your last slide, the country factors, when you incorporated ESG at the macro level, the factors changed. So I'm sure when you're evaluating ESG in emerging markets, which one is the most, important for you, and which one is difficult to analyze?
I mean, not just for EM in general, the social pillar or the social issues in general are the most difficult to evaluate. So for environmental topics, so typical topics in environmental would include carbon emissions or physical impacts of climate change or air pollution. You would have, I would say, quantifiable metrics there. So what's your carbon intensity? What's your carbon footprint? What's your SOx NOx emissions, say per $1 million revenue, and so on and so forth. So this is like standard data that you would typically find, and you don't need to apply a lot of judgment. And same goes for governance. Like corporate governance has been, I would say, looked at for at least 20 years, maybe more in the investment space. So like views on board independence, views on how the committee is formed, and so on and so forth. They are like very standardized across markets. But the S is where it's both more difficult to quantify and also region specific. So if you think about, let's say, managing labor, so what kind of policies are sufficient in an emerging market context might be looked at as, let's say, below par in developed markets. And typically what happens is the third party ESG ratings are working in a best in class kind of approach. So for them, what is the best practice in the world today gets a 10 on 10, and everyone else's benchmark versus that. So what happens is, I would say more often than not, EM companies might be getting kind of, let's say, lower scores because of this kind of perception gap. So they often would come and complain and say, okay, we meet the local regulations, but that's not enough, let's say, from a global best practice perspective. So S is generally, I would say, the most difficult to quantify, but it might not be I would say, it might not be that less looked at going forward, especially in light of the pandemic, like social issues. So both at the country level, like I already mentioned, but also at company level, like health and safety of employees, management of human capital, and so on and so forth. Data privacy, now everyone is working from home. So how do you kind of ensure the right tools are available for you to seamlessly do business, but also safely? I mean, these issues have become more and more important. And I think investors, including us, are paying more and more attention to these topics. So I would definitely see, I'd say, more weight being given to aspects in the future. But I think historically that's been one of the, I would say, the adopted challenge in some ways, because it's just difficult to quantify. You always feel this might play out in the 50 years or 20 years time horizon, but not immediately. But COVID has definitely broken all of those misconceptions.
Yeah, so these qualitative factors are difficult to, analyze also. And even companies, I think they would not be publishing it anywhere else, right? So very difficult, to see even the code of ethics, like availability and things like information about diversity, inclusion, and, all those things available in the published sources. So unless you have their interaction directly with the company, I'm sure that is a problem there. But otherwise, yeah, corporate governance, they have a mandatory reporting, so they will be doing that. And even the other quantitative framework and environmental reporting is also compulsory. So
Yeah. No, but I
yeah.
mean, the regulations are changing quite a lot. So even if you
Mhm.
see in emerging Asia, I think probably since 2012, the Indian stock regulator has a mandate for the top listed companies to share sustainability information. Chinese regulators, I think starting this year, Chinese companies have to disclose their environmental risk monitoring and environmental impact. So I would say, I mean, it's not that companies in EM are not disclosing. I think it's usually often just a case of, like, what we've found is, even when we engage with the management, we have to just let them know why this is important or why are we asking about this, and I think they're more than willing to share in most cases. But
Mhm.
it's just that no one ever asked about it, and maybe due to limited resources in smaller companies, they might not have the large sustainability teams to come out with like a 50-page sustainability report. So I think from my perspective, again, analyzing companies, I don't really want like glossy reports with CEOs holding babies and meeting the poor farmers in somewhere in the rural area. What I
Mhm.
want is maybe even 2 pages, but relevant information, which is decision useful for me. Yeah.
Yeah. So another question to you, Mr. Shah, that how do you incorporate that into valuation, or into your returns expectations when you look at these factors?
Sure. So I gave you an example of the country model. I'll probably walk you through one example of how we integrated at a company level. This is a live, I mean, like a real life case from one of our emerging portfolios back in, I think this is probably early 2018. So we were analyzing a Chinese cement company's ESG risks, and essentially our team felt like the company was not managing its carbon emissions really well and toxic emissions. So we thought there is a risk because I think back in December 2017, China has already announced the carbon cap and trade scheme coming in. So essentially, companies will have a carbon quota or will have to pay to buy excess credits if they don't kind of meet or their emissions are in excess of their quota. So this was a classic example because the fundamental analyst in the team was very bullish about this company, whereas the ESG team was like, this is a very high risk company. So how do you solve that, right? So our team basically works in like bull bear base case IRR estimates. So I won't go into details if there are folks who are non-finance background, they might just get bored. But essentially saying what is your expected return from this investment in the worst case, in the best case, and let's say in the average case in some ways. So before ESG integration, we were expecting let's say about 12% return from this investment. But after factoring in a lot of these risks that the ESG team had flagged, so for example, the company will have to do additional capital expenditure to meet the new GHG emission standards that will that will erode the margin. We'll have to, let's say, change some equipments to meet the new air emission standards. So China has been fighting air pollution for the last 6-7 years now. So gradually those regulations are strengthening. So companies will have to kind of spend more to meet those demands. And hence we made some adjustments to the different kind of components of the IRR. So for example, expected revenue growth, margins, dividend, etc. And as you can see from about 11.5%, it kind of the expected IRR went down quite significantly to 3.5%. So in this case, what happened was then this company wasn't really that attractive as an investment option. So our position size was much smaller compared to what we would have taken in, let's say, in absence of ESG information and in absence of these risks. So this is just one example of how it plays out. Now, what is important to note is not each and every company will have such a, I would say, a drastic change. This is like one of the extreme cases. I think in most cases you might feel ESG risks are not too bad enough, or maybe the ESG opportunities are not too good enough. So maybe there's minimal impact on the IRR or your view, but you would want to definitely not miss out on some of these extreme cases because one of these misses would actually cause a large drawdown and that could impact your portfolio for a long period of time. So this is just an example of how we think about it.
Yeah. Thank you. That's really insightful. Even that's something new for me also to know. So, Edris, like Mr. Shah explained about the valuation, so is there any difference between ESG analysis for fixed income or debt securities and the equities?
I think yes and no, depends on where you come from. And I think it depends, quite importantly, how long you intend to hold the asset for. Why I say this is because, for instance, from Maichi's perspective, we are long-term investors. We are interested in a company when we invest in their fixed income that they're able to pay coupons. And also we want to make sure that in the event that we want to tell them that they have a good value, right? For shares, we want to look at holding the shares in the long term, and we hope that their value will go up. So in the long term, we just want the company to be more sustainable, to be more resilient. And when we put on that ESG lens, it tends to then look in the same way. When we engage them, it might seem that it doesn't make a difference whether it's a fixed income asset or an equity asset. There might be a bigger difference if we are thinking of holding it in the shorter term. And I think one of the things is also to look at it from a company perspective. Okay, if an investor comes to them and we say that we are an equity holder, as compared to an investor who says we are your debt holder, what would their response be? I think in the past, it would have been a bit more different, where if you have the ability to turn up at the AGM and make a difference or make some noise at the AGM, they might take you a bit more seriously. But what we have observed in our engagement with a lot of companies is they either respond to investors or they don't respond to investors. They don't really look at whether you're a fixed income investor or an equity investor nowadays. Yeah.
So that means the engagement, that differs with the company, right? So the ESG
Yeah,
engagement. Yeah.
very
So.
much differs by the company. I think it really depends on the senior management and how serious they are. What we have noticed is companies in the East Asian market, they tend not to be so responsive when we reach out to them. So we try to work using different ways, collaborate with other investors. We use the Climate Action 100 plus coalition, which is something that Maitri is part of now. And we also, uh, what we want to have built is a long-term relationship. So it's not that we reach out to them today, they don't respond, we stop reaching out to them.
Mm-hmm.
We try and, on a quarterly basis or a half-yearly basis, every time that we think it's a good time, we are looking at the industry or the particular company, we will reach out again. Yeah.
Okay.
Yeah, Nisha, if I
Yeah.
can chime in a little bit on this topic.
Yeah,
So I think the
sure. I
key,
was going to ask you that one.
yeah,
Yeah.
I think the key difference in looking at ESG or integrating ESG for fixed income versus equity is in the fixed income aspect, you are most concerned about the downside risk protection because the
Yeah.
bond would always redeem at par, right? You don't
Yeah.
have an like upside in that sense. So
Mm-hmm.
for fixed income investors, it's always like what kind of risk could impact the ability to repay, and that's what I'm concerned about. For equity, apart from that, there is also this growth aspect, right? So you could, if you invest in businesses which have uh, solutions for mitigating or adapting climate change, now that is going to be more and more in demand in the future. So that sector or that kind of business will have more secular growth. So there is a lot of upside. There's not always risks of when you're looking at ESG. There's also strengths or opportunities
Mm-hmm.
that investors look at. In fact, I mean, at GMO, we are running an entire fund on climate change opportunities. So we are not saying we want to give you a low carbon fund or anything. What we are saying is these businesses would help either mitigate or adapt to climate change, and we feel these will kind of grow much better than the normal market, and hence we feel you should be invested in this. So there is definitely an opportunity or upside for equity investors, whereas fixed income is mostly concerned about downside protection.
Okay. Yeah. Thank you so much. And Idris was mentioning about engaging with the companies. So does GMO also engage with the companies to meet the ESG criteria? And if, like, let's say the companies are not up to mark, certain investments that you're considering, and if the companies are not up to mark, do you work as a catalyst for change in those companies when you invest? I'm sure it would take, it requires a lot of effort. Like it's kind of an active investment strategy. But,
Right.
at what level do you do that?
So I would say there are two ways in which we approach our, I would say, stewardship or like active ownership responsibilities. I think the most common one is via proxy voting. So what we have done is we've adopted ISS's sustainability policy. So ISS is one of the proxy voting providers, and they have certain sustainability criteria defined, saying on this topic, this is how we would vote, and which is typically in favor of company being more sustainable or more transparent, and so on and so forth. So all of our voting for the last 2+ years is happening according to that policy. So that's one. In select cases, and this is, I would say, more for GMO's fundamental portfolios. So we run both quantitative and fundamental strategies. So for the fundamental portfolios, both in emerging and developed markets, we have selective direct engagement with the company management. So, the way we identify companies for doing so is a mixture of the degree of exposure, so which are some of our larger holdings, as well as the ones which we feel are having significant unmanaged ESG risks. So this combination, so we don't engage with each and every company in the portfolio. Again, as you mentioned, right, there is time and resource constraint there. But yes, I think in general, either via speaking at webinars like this or maybe other public forums, we just make sure that our messaging is clear, that we want them to be transparent. We want them to be, I would say, proactive in communicating. And generally, I think, at least me personally, what the message I give companies is, whenever I address them, is, I don't want you to stop reporting when the metric kind of turns negative. So if your carbon intensity is going up, you stop reporting, and then only when it's going down, you start reporting. And that's not the way. I think I would appreciate a company more if they say, yes, this is the reason why it went up, and this is what we are going to do in the next 3 and 5 years to solve that. So this is, I mean, ESG issues typically won't get resolved in a 3 month or a six month period. So you have to be patient. You have to give the management time to act, and I think I would say in most cases they are open to listen to you, and it's not us. Like, I mean, maybe 5 years back there were very few investors asking for this. Now I think it's becoming more and more common. So that's what I would say about like our engagement and some of the practices we employ.
Yeah. So you are on the like demand side of the investment and the companies are the supply side, right? So you invest in those companies. How much is the awareness, noticed by you in past few years about ESG? And do companies, proactively, we do have those rating and metrics agencies, that's fine. But on their own, are the companies motivated to do this ESG implementation in their businesses?
Um, so my experience has been proactively companies would always pick the low hanging fruit, which is what kind of gives you cost saving, right? So you don't need an investor to tell them if you do energy efficiency, that's going to impact positively your bottom line. So that is something that they will obviously know and want to do. If there is a regulation coming, then they would want to be on the right side of the regulation. So proactively, that's how I think any company would start. Some of the more mature businesses or some of the businesses who are either having international or global stakeholders, either in terms of their customer base or investors, are the ones which would kind of go beyond the usual local regulatory demands and do more and more in terms of both communicating but also setting targets and things like that. So that has generally been my experience thus far.
Okay.
Yeah.
Okay.
Yeah,
Thank you so
sorry,
much.
if I can just
Yeah. Sure,
jump
sure.
in here. I think, yes, I agree with Hadik. Also, one thing is state-owned enterprises. So enterprises that tend to be owned by the government or different countries, they tend to be have a different, they're in a different league altogether, right? Sometimes when you engage them, even if they're from a country where a lot of companies tend to have the culture of responding to you, they might not respond. It's just the nature. I
Mhm,
think it's an additional lens, it's a different lens that we need to apply on. I
mhm.
think the country analysis does come into play. Most of this time, it's emerging market countries, right? And a lot of times we have this, we might have to take this view. They are in a transitioning state where a lot of they are big, powerful companies, and they have the ability to make a significant difference to their own country. And so, in that way, we might see that it's an S social factor for their own country, but they might be doing environmental, or they might have some environmental or social controversies in other countries in their business practices. So I think we need to, the engagement needs to continue with these kind of companies, um, because they need to know that even though they're state-owned, the reason, them being a state-owned company actually means more because they are kind of like the face of the country as well, right? So we do need to continually engage them even if they don't respond. Yeah.
Okay. Okay. Thank you so much. Now comes a very important question. Nowadays we are seeing the term called greenwashing. So, and what is this greenwashing? So, due to proliferation of governmental and non-governmental, like transnational commercial frameworks, and we have seen like a lot of frameworks are, present, like PRI, SRI, SDGs, and so on. So this actually with the corporates are able to attract more investments due to their sustainability scores over the spectrum. They try to gain on the scores and the ratings, right, from good to bad, and depending on the methodology whatever is used, so they try to bring up their rating. And such a fragmented landscape, it serves as a breeding ground for the term called greenwashing, which is a phenomenon that's threatening to undermine ESG related political commitments. And even like you just mentioned about the country scores, right? So even the political commitments are involved, and especially the goal of channeling private investments towards genuinely sustainable economic activity. So what are your views about greenwashing, and what do you think, how can we downplay it, or how can we reduce that? So first, you can Mr. Shah, you can start with this. It's a question
Sure.
for both actually.
Sure. There are two different aspects to greenwashing, right? One is what corporates disclose for investor or stakeholder consumption, and the other is on the investor side as well. So I'll talk about both briefly. I think in simple terms, greenwashing is not walking the talk. So you just kind of do a lot of talk on ESG and sustainability and so on and so forth, but don't really implement it in your day-to-day business practices. It is definitely a threat to the I would say the wider adoption of responsible investing for sure. Um, there are ways in which investors like us are trying to, I would say, separate the greenwashers versus the actual serious, let's say, performers here. So, and that's one of the reasons why I mentioned earlier that we should not rely on third-party ratings. I've worked at both the agencies, and I would say it's not very difficult to game the system to get a higher score because you might disclose, let's say, all of your carbon footprints, but only disclose it for your Singapore operations, but not global operations, that kind of stuff. So companies have ways to do it, but I would not think I think it would go a lot far going forward because investors have become smart, have been asking the tough questions. So I would just say it's probably a thing of the past that companies can get away with it. From the investor side, and maybe I'll let Edris talk a little bit more on that. I'll just briefly touch upon it. I think with unfortunately with the growing demand for ESG investing, asset managers have also been tempted to throw out products at a very high frequency who just do maybe a little bit or maybe don't do a lot at all, but just the title has a sustainable fund or an ESG fund just to gather assets. So unfortunately, that has happened a lot. But I would say in the next 3 years or so, all of that will kind of also stop because I think in my intro, you mentioned that I'm working with the CFA Institute on a standard for ESG disclosure. So that standard is aimed at asset managers. What kind of disclosure should you provide if you claim your fund is an ESG fund? And that will help the end consumer, whether it's a retail investor or an institutional investor, to, I would say, separate the green washing in some ways. So I'll pause there and maybe let Edris talk a little bit more on that.
Yeah, thank you.
Yeah, thanks very much, Hadik. I had a little giggle when you said gaming the system because when I used to write sustainability reports and yeah, so we're always trying to figure out ways sometimes, but when the management is serious about it, I think that makes a significant difference. And in terms of, maybe I can just share my screen on the spectrum of ESG investing. Right. So this is one figure that I always refer to, because when we talk about ESG investing, it could mean different things to different people. So when I say that, I'm on a certain level, this is what I do, someone else might say, hey, that's considered greenwashing. I'll have to explain myself on what I'm doing, and then that person will then have to decide, okay, is that still considered greenwashing? I think the starting point is always understanding what is the spectrum of this ESG investing we're talking about. Hadik shared a little bit about SRI and RI, and I think that's definitely one way to look at it. I like this diagram from the AVPN. It's the Asian Venture Philanthropy Network. This is document. So in the past, when we look at philanthropy, a lot of families who were able, who wealthy families that were looking at giving back, they would give back without having a return in mind. That's philanthropy, right? And we've kind of worked our way, and I think impact investing is something that's very commonly heard in recent times. That involves, I would think that microfinancing is something that's very common because you are actually using your money, you're coming up with capital, you're giving it to someone, but you expect that person to come back with a return. Knowing that person has restrictions and limitations, so you don't expect like a market market return, right? You expect a little bit of lower return. So that's typically impact investing. And if you look at thematic, and Hadik touched about it as well, it's more focused, one or two areas, environmental or social areas. You could be asking for a lower return of investment. You could be asking for a market return, right? And then we go into responsible and sustainable. And when Dr. Nisha, you mentioned the word ethical. So
Yes.
to me, I would see ethical under responsible, because I think being ethical and being responsible is similar. Where I am looking at having a high benchmark in terms of what I do, setting a high benchmark for myself. And in terms of being sustainable, I think what it means is, okay, I want something to be able to continue going forward. So a slightly different, definition and interpretation depending on who we're speaking with, right?
Okay.
So when we look at Mindtree, for instance, we see ourselves as responsible investor, and we have a sustainable fund, right? So we really practice the ESG integration part of this ESG investing. And so if someone comes up to us and say, hey, but are you making an impact on people who are underprivileged, for instance? I would say that most of our activities, our investments are in the public markets. So when we talk about impact investing, we do have some exposure, but it's much smaller. But 25% of Mindtree is actually owned by a foundation. So a lot of our impact is actually done through our foundation. And so the person is asking, is Mindtree or is an investor into greenwashing? I think we need to understand where it's, and then you decide whether it's a true sustainable, responsible investing. That's my.
I asked this question because few days back I was reading an article where hedge funds are shorting their securities, shorting their investments for for the reason of greenwashing. So yeah. So the
I
next.
think, if I could just add a quick point on that, I think the Japanese pension fund, the GPIF, they have made it their quite publicly a statement that they will not engage in shorting, right? But I think that is quite common in US for investors to actually engage in. So I don't think there's a right or wrong. In that. I think it depends on what's the instruments and tools available to that investor.
Okay. Yeah. Thank you. Please share your final thoughts on what the future trends, investors should be thinking about. So, Mr. Shah, we'll start with you, just to have a closing remark on this discussion.
Sure. I would think the sustainable development goals would be definitely in focus in this current decade. These are like very large, wide, kind of spanning goals, and the world pretty much has 10 years to achieve most of them. I think that is definitely going to be an important theme. Any products or companies that are trying to help, I would say, address one or more of those goals would be in demand in general. The other aspect, and it's partly covered in Goal 13 of the SDGs, but it's a climate action in general is going to be more and more impactful. I think in the investor community, but otherwise as well, the political community, you are getting more and more support for positive climate action and proactive climate action. So I would say these are the two areas which would be on top of investor minds, at least in the next 5 years. Yeah.
Thank you. Idris.
Yeah, so I would think it's ESG integration into the investment framework. If we look at globally, the Network for Greening the Financial System, they are a network of central bankers, supervisors, they're coming together to try and set best practices for what the financial system in each country should be. And if we look at Asia, the Monetary Authority of Singapore, the People's Bank of China, they were the first. They were 2 of the 8 founding members. They are actually representatives from Asia, and I think they're taking good stride in ESG investing. Right, the People's Bank of China has actually recently said that we are proposing to take coal utilization of clean coal from our green bonds eligible project, because in the past it was eligible. And that was a point of contention for a lot of global green bond investors. So in the next 5 years, they're planning to take that out. If we look at the Monetary Authority of Singapore, they just came up with a set of guidelines that's proposed, right? It's a draft. they're asking for consultation feedback right now.
Mm-hmm.
And a lot of it is aligned to the TCFD, the Task Force for Climate-Related Disclosure. And I think in terms of ESG integration, that was very strongly mentioned in the MAS guide. So how are investors, asset managers, asset owners going to build this ESG integration into their existing framework? I think that's the next big thing.
Mm-hmm.
The other thing that I wanted to talk about also is disclosures on the part of investors.
Mm-hmm.
I think corporate companies, they've been talking about coming up with their sustainability reports for many years now. And I think with the TCFD coming into the picture, very much, especially in Singapore, I think in the near future, I think investors will be pushed to report and disclose a lot more. And I think it will help with separating what is greenwashing and what isn't.
Yeah. Okay. Thank you so much. Let's. I think we'll take the questions answered. Okay, you already answered the question. So
I've
there.
answered a few.
Okay. So there is one more in the chat. Do we assume that GMO bumps up the return threshold with the ESG risk?
Yeah, I mean, the way you look at it is what kind of, as I explained in the company integration example, like the Chinese cement company. I think the way you look at it is what kind of impacts would this ESG risk have in case it materializes. So that's one aspect of it. But there's also another aspect of probability of it materializing, right? So it could be that the company is just simply lucky and there is no health and safety accident, even if they are not managing the risk well, but it could be that even if they're managing everything well, there might be one tomorrow. So I think as an analyst, the key decision we have to make is what is the likelihood of that kind of risk impacting in our, let's say, holding period or in our investment horizon. And that's how you would then take a decision whether you want to, let's say, increase cost estimates or reduce revenue generation and so on and so forth. There's multiple ways you could ESG issues could impact, but that's how it typically would work here.
Okay. So another question that has just come, how easy do you find it to determine ESG metrics in African countries? And do you invest in African countries? Is it transparency sufficient?
I wouldn't have a specific examples, but yes, we do invest globally. Our investments are in the secondary market. So in that sense, even if we talk about Africa, then we would not go to some of the smaller countries where the market cap kind of are limited for listed companies. It would typically be South Africa and maybe some of the other larger countries there. Um, I think transparency is generally an issue in emerging markets, but that has changed in the last 3 to 5 years quite significantly, as I was mentioning earlier. Um, so the way I'd say we would approach this as an investor is just because a company has a low ESG rating doesn't mean it becomes ineligible in some ways, because the reason for the low ESG rating could be, let's say, two. One is they just don't disclose anything, and MSCI has given 000 everywhere, and hence you have a triple C rated company. The other is they do disclose some things, but there is a performance issue, right? So the carbon intensity is too high, or maybe they're involved in some controversy related to ESG risk. And the latter is what I would be more concerned about, because that would mean that ESG risks are kind of playing out negatively, and that's where you would want to either push for more disclosure or maybe just avoid some of those companies. But otherwise, just a poor disclosure is not always the reason for, let's say, staying away.
Mhm.
Yeah, I could add, actually in the African continent, I think what we do see is supranational development banks, and like World Bank, the IMF, they tend to have a much bigger say, especially because they are the ones that are mainly funding the project. So when they actually have the standard, the IFC, for instance, they do have standards, but I think currently a lot of the reports are not very publicly available, or not disclosed. If all these reports can actually be disclosed, it probably will give a boost to the African continent. Yeah.
So, yeah. I think we have taken up all the questions. Uh, Okay, I think this question is similar to what I also asked, just to make sure. How much are companies doing with ESG report to de-risk their business? And is it reporting for reporting sake, or does that translate into real on-ground translation? What are your insights?
I mean, as I mentioned earlier, I think the cost saving exercise is definitely we will translate it in reality. Reporting more often than not starts because of a regulatory pressure or investor pressure. So it will be reporting for the sake of reporting. Or if you're asking me 12 points, I'll not give you 13 point. I'll just give you those 12.
Mm,
But I think over a period of time, it does evolve. The company does figure out when they do serious analysis that some of these things could be beneficial in the long run for their own business sustainability, taking care of employees or managing other carbon emissions, for example. So maybe today there is no regulation, but it could come in 5 years. So you can't just overnight change your business footprint to be low carbon, right? You have to take a phase approach. So those kind of things, I think generally companies are aware of and paying more attention to. Yeah.
So my perspective is, and I've stressed this quite a few times, senior management and board direction is very important. If they say that to take it seriously, they will.
mm,
In my previous life, when I was working as a consultant, I had the opportunity to work with the Singapore Exchange on
mhm,
the landmark project to, come up with sustainable reporting guidelines for listed companies. Over the 1 year, what we did was we ran focus groups with listed companies, the C-suite attended, and they gave their feedback on what their concerns were with different benchmarks of requirements made, right? So we tested different requirements, and the feedback in general was it had to be reasonable, it could not be too costly, and
mhm,
it had to be something that gave value back to the business, right? And a lot of times what we see is some of these things are already practiced in the company, in their ERM, um, and in their enterprise risk management system. A lot of times they don't put the environmental lens, they don't put the social lens. They're not motivated. They were not motivated to do that, right? And that's why the regulator had to come in to say, start looking at it. I'm giving you a motivation because otherwise you'll be breaking the law or breaking the rules.
yeah.
So one one way that the regulator tried to make it more palatable was to say only report on those that's most material to you.
Mhm,
And when you say materiality, it's not so much in a financial sense, right? Or how much is the impact as compared to your revenue or your profit. It's more if something happens today to your
mhm,
your environmental aspect, okay, or if something happens to your social aspect. Real life example: if today you were found to have polluted a river, or if today you were, there was a massive accident uh, that had a fire in your factory, what would happen to your business?
mhm,
And that is material to a lot of businesses out with operations. And so when you put that in perspective, the business has to say, okay, you know what? Actually, I already have all these practices in place, but I'm not ready to disclose that. So when
mhm,
we have the regulators come in, what they're trying to tell the companies is, I want you to be ready to disclose that. So
mhm.
they will then have to take a look at themselves and say, okay, I think I've got a bit of gap here. I better close it before I disclose it.
Yeah.
And that is the practice that the regulator actually really wants to see. And
Mhm,
when they are able to, when the businesses are able to report in with that kind of mindset, it then helps to de-risk their business,
mhm,
right? But if they're taking the mindset that I will just engage a PR agency to come up with a report, interview a few staff, take a few nice photos, then that really defeats the purpose, which is not the intention of the regulator at all.
okay. Okay. Thank you so much. Really insightful to hear all these, points from you, address regarding the frameworks that, the disclosure frameworks adopted by the governments, and that how they are, motivating the companies to report their disclosures. I think we have exceeded the time already, so we need to close. And definitely, I'm looking forward to do another session on ESG. And the topic that I have in mind is about ESG and value creation. So this point that we just now discussed, the last question that we discussed, I think we can take it forward in a one full another session, and we can talk a lot about that. So thank you so much, Mr. Shah and Ms. Edris Boy, for your time and coming on our panel. We are really obliged for that, and we look forward to interacting with you further and learning more from you in our future sessions. Thank you so much.
Thank you very
And
much.
Thank you. Have a nice evening.
thank you.
Cheers. Bye.
Bye bye. Thank you so much, our attendees. Thanks for attending the session today. Please look forward to another session on ESG and value creation in the near future. Thanks a lot for your attendance today. Bye bye.